before you learn a single strategy, before you look at a single chart pattern, before you understand liquidity or order blocks or any of the concepts that will come later in this series. You need to understand one thing first. What is actually happening when a market moves? Not the surface answer, not the definition from a textbook, the real answer, the mechanical answer, the answer that explains why price goes up when it goes up and down when it goes down. Because if you do not understand this first, everything that comes after it will be built on sand. And a structure built on sand does not hold. This is video 1 of the complete trading series, and we are starting at the absolute beginning, not financial advice, just education. Let's get into it. Let's start with the most fundamental question. What is trading? At its simplest, trading is the act of buying something and selling it at a different price. That is it. You buy at one price. You sell at a different price. If you sell higher than you bought, you made a profit. If you sell lower than you bought, you made a loss. Every trade that has ever happened in every financial market in history follows this exact same logic. The complexity comes not from the concept, but from understanding what you are buying, who you are buying it from, why the price changes, and how to position yourself so that the price moves in your favor more often than it moves against you. This series answers all of those questions, but it starts here. With this simple foundation, now let's talk about what you are actually trading when you open a chart. In financial markets, you are not trading the thing itself in most cases. When you trade Forex, you are not physically exchanging bags of currency. When you trade a stock, you are not picking up a share certificate from an office. When you trade a futures contract on oil, you are not arranging a delivery truck. What you are trading is a contract, an agreement, a position that reflects the price of something in the real world, and the price of that position changes constantly because the market is constantly reassessing the value of what that contract represents. This constant reassessment is what creates movement, and movement is what creates opportunity. Now, here is where it gets interesting. A financial market is not a store. In a store, there is a seller and there is a buyer. The seller sets the price. The buyer decides whether to accept it. Simple, one way. But a financial market is an auction, a continuous real-time auction where every participant is simultaneously a potential buyer and a potential seller, and the price is always the result of their collective negotiation. There is no single seller setting a fixed price. The price is whatever the most recent transaction happened at, and the next price will be higher or lower depending on whether the next transaction was initiated by someone who wanted to buy or someone who wanted to sell. Here is the one idea that changes everything about how you understand markets. Price does not go up because there are more buyers than sellers, and price does not go down because there are more sellers than buyers. This is one of the most common misconceptions in all of trading, and it is taught everywhere. The truth is mathematically simple. Every single trade requires exactly one buyer and exactly one seller simultaneously. If you buy one Bitcoin, someone sold you that Bitcoin, without exception. The number of buyers always equals the number of sellers in any completed transaction. What actually moves price is not the quantity of buyers versus sellers, it is the aggression of the side that is initiating. When buyers are aggressive, they are willing to pay higher prices to get filled. They are lifting the offer, accepting whatever price is available. Their aggression drives price up. When sellers are aggressive, they are willing to accept lower prices to get out. They are hitting the bid, accepting whatever price is available. Their aggression drives price down. Price movement is about which side is more desperate, more motivated, more urgent, not which side has more people. Think about it this way. Imagine two people at an auction for a painting. One person wants the painting and will pay any price to get it. The other person has the painting and is happy to hold it unless someone offers a very good price. That dynamic, one side aggressive, one side passive, is what determines where price goes. In financial markets, when you see price rising quickly, it means buyers are urgently lifting offers, accepting higher and higher prices because they believe the value will be even higher soon. When you see price falling quickly, it means sellers are urgently hitting bids, accepting lower and lower prices because they believe the value will be even lower soon. The speed and conviction of that aggression is what you see on a chart as the size and character of each candle. Now let's talk about the participants in the market. Because not everyone is trading with the same size, the same information, or the same objective. Understanding who is in the market with you is essential because different participants behave in predictable ways, and those predictable behaviors create patterns you will learn to trade throughout this series. The first group is retail traders. That is you. That is most of the people watching this video. Retail traders are individuals trading their own money, typically through a broker platform in relatively small sizes. A retail trader might be managing a few $100s or a few $100,000. In the context of a global financial market that trades trillions of dollars per day, even a relatively wealthy retail trader is an extremely small participant. Retail traders use publicly available information, technical analysis, trading courses, YouTube channels, forums, and their own experience to make decisions. They are reactive. They respond to price movement rather than creating it. The second group is institutional traders. These are the large players, hedge funds, investment banks, pension funds, insurance companies, proprietary trading firms. These participants manage billions of dollars, and their individual trades are large enough to actually move markets. An institutional trader placing $1 billion order cannot simply click buy and get filled at one price. Their order is so large that filling it all at once would move the price against them before they finish. This is a critical point. Institutions cannot trade freely because their size is their problem. They need to disguise their activity. They need to accumulate positions slowly over time in ways that do not alert the market to what they are doing. And the way they do this creates the patterns you will see on charts. Patterns that this series will teach you to identify and trade alongside. The third group is market makers. Market makers are entities that exist specifically to provide liquidity to the market. They quote both a buy price and a sell price simultaneously, and they profit from the difference between those two prices, which is called the spread. Market makers are not trying to predict direction. They are trying to manage inventory, balancing their buy and sell exposure while collecting the spread on every transaction. When you open a trade with your broker, in many cases you are trading against the broker's own market making desk or a connected liquidity provider. Understanding this is important because it means your broker has interests that may not always be perfectly aligned with yours. Now let's talk about how price actually moves in practice, because understanding buyers and sellers in theory is one thing. Seeing it on a real chart is another. Let's use Bitcoin as our example because it is accessible, familiar, and trades around the clock, so there's always movement to analyze. Imagine Bitcoin is trading at exactly $50,000. At this price, some participants believe Bitcoin is cheap and want to buy more. Others believe it is expensive and want to sell. Others are neutral and waiting to see what happens. This is the market imbalance. The price represents the current consensus about value. Now imagine a large institution decides it wants to accumulate a significant position in Bitcoin because it believes the price will be significantly higher in the future. It cannot simply place a massive buy order because that would immediately push the price up, meaning it would be buying its own position more expensively. Instead, it begins to accumulate quietly. It buys in small amounts across many different prices. It may allow price to dip slightly, even helping create panic in retail traders who then sell their Bitcoin cheaply, giving the institution more inventory at lower prices. This slow, patient accumulation is what creates the sideways consolidation zones you see on charts before major moves. The price is not going nowhere. It is being slowly loaded with institutional buy orders. Once the institution has accumulated enough of its position, the dynamic changes. The supply of willing sellers at current prices starts to dry up because the institution has absorbed most of them. With sellers becoming scarce, any new buy order has to go to a higher price to find a willing seller. Price begins to rise. More participants notice the rising price and want to buy, adding their own demand. The momentum builds. The institution, which accumulated at lower prices, is now watching its position become more profitable with each tick higher. This is markup, the phase of a trend where accumulated positions begin to generate returns, and where momentum attracts more and more participants. Eventually, price reaches a level where the institution wants to exit its position. It has made its profit and wants to lock it in. But it faces the same problem in reverse. It cannot simply sell everything at once because that would crash the price before it finishes selling. So it distributes its position slowly, selling into the demand created by retail traders who are now excited about the price rise and buying aggressively because they fear missing out. The institution is using their FOMO buying as liquidity to exit. Once the institution has sold its position, the support that was holding price up disappears. There are no more large buyers absorbing the selling. Price begins to fall. Retail traders who bought near the top are now sitting on losses and eventually panic, adding selling pressure. This is markdown, the phase where the smart money has exited and the uninformed money is left holding positions that will continue to fall. This four-phase cycle, accumulation, markup, distribution, markdown, repeats endlessly across every financial market at every time frame. It is the heartbeat of every chart you will ever look at, and every concept this series teaches you, from liquidity pools to order blocks to volume analysis to price action patterns, is a tool for identifying where in the cycle the market currently is and positioning yourself accordingly. Now let's look at this on an actual Bitcoin chart so you can see what this looks like in practice. A period of sideways movement where price oscillates in a range without clear direction. This is accumulation. Large players are loading their positions. Retail traders are bored and confused. Then a breakout occurs with expanding volume and large decisive candles. This is the beginning of markup. Trend followers and momentum traders join. Then a period near the highs where price makes new highs, but the candles become smaller, volume becomes erratic, and progress slows. This is distribution. Smart money is exiting. Finally, a sharp decline, often faster than the rise, with momentum and panic. This is markdown. And somewhere at the end of that markdown, accumulation begins again. Now, here's the most important thing a beginner can learn from this first video. The market is not random. It does not move because of luck or because charts have magical patterns. It moves because of the decisions of participants with different sizes, different information, and different time horizons. And those decisions leave traces on a chart. Every candle tells part of the story. Every volume bar adds evidence. Every sweep of a swing high or low has a reason. The entire purpose of this series is to teach you how to read those traces, how to identify who is doing what and why, how to stop being the retail trader who provides liquidity to institutions and start being the trader who positions alongside institutional activity before it becomes obvious to everyone else. Here is the mindset shift that should come from this first video. Most beginners approach trading thinking the market is a puzzle to be solved. Find the right indicator, find the right pattern, find the magic formula. The market is not a puzzle, it is a competition. And in this competition, the participants with the most money, the most information, and the most patience consistently take money from the participants with the least of all three. Your job is not to find a secret formula. Your job is to understand the competition well enough to avoid being the one who loses and eventually to position yourself on the same side as the participants who consistently win. That understanding begins here, with knowing what trading is, with knowing who the participants are, with knowing that price does not move randomly, but because of the aggregate decisions of millions of participants, some of whom have enough size to move the market themselves. And with knowing that the chart on your screen is not a collection of random candles, but a real-time record of a continuous negotiation between those participants. In video 2 of this series, we go deeper into the specific financial markets you can trade: Forex, crypto, stocks, and commodities. What makes each one different? What makes each one the same? And which one is right for you depending on your situation and goals. I will see you there. Stay disciplined.